Tom Lee says we're not in a hype cycle, we're in an exponential supercycle. Today we're unpacking exactly what that means for your portfolio and how to position for the next leg of this AI-driven market. Lee, Fundstrat's head of research and CIO, just went on CNBC's Closing Bell and made a strong case that while there will be an AI shakeout, the leaders aren't priced like the late 90s bubble. In other words, the winners still have room to run if you know where to look. In a moment you'll see the clip. After that, I'll break down his key points in plain English. Why certain AI names deserve premium valuations, how to separate true ecosystem scarcity from only public proxy hype, and where the productivity wave spills over next. Then, I'll share my own playbook for this environment, including 2 AI stocks to buy for the long haul. Names with real earnings power and durable competitive moats, not just buzz. If you're serious about compounding through this cycle, you'll want to catch every second. Tap the like button. Let's hit 1,000 likes. Share this with someone who needs a reality check on AI, and drop your thoughts in the comments. Make sure you're subscribed so you don't miss the follow-up deep dive. Alright, let's hear what Tom Lee has to say.
We're in a period where there is a super cycle and exponential growth opportunities within AI, but it doesn't mean every company that has an elevated valuation today deserves to actually have the capital, and that company may not even reinvest that capital properly to be a survivor. So I agree there is going to eventually be a shakeout, but I think valuations, strangely enough, are actually pretty reasonable today compared to 1998. Because, 1998 was that liftoff point before that final 18-month surge. And I'd say the best benchmark is NVIDIA trades at 26 times forward earnings. Cisco, at that same exact moment, was at 60 times. And Cisco's PE peaked at 210 times forward earnings. So NVIDIA, to me, is still a bargain at 26 times. It's cheaper than Costco and Walmart, which are close to 50 times forward earnings.
Sure, but all valuation isn't created equal. And I'm not especially clear as to whether Mr. Griffin looks at the valuations of an NVIDIA, for example, and says, well, that looks a little out of hand. It reminds me of late 90s activity before the dot-com bust happened, parabolic. And they're related to AI. And that's where he says, whoa. We're placing way too many bets on what might happen in the future. We think we know what's going to happen in the future as it relates to NVIDIA and some of the other hyperscalers, but it's a whole host of other names that have literally ripped over the last 3 months, at least, that might bring investors a little bit of pause.
I think that's correct, Scott. There's a difference between a company being scarce in the public market. Like, let's say there's an IPO of a company and it's the only way for you to get exposure, versus that company being truly scarce to the ecosystem. So I do think investors have to discern, is this company going up a lot because this is the only name out of a possible bevy of private companies, or is this the company truly unique and one that is so scarce I got to give it the N=1 valuation?
I mean, I think he looks also at a stat like JP Morgan Asset Management's Michael Sembalist brought to us today from his report. And he's good at what he does, okay? Quote, AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth since ChatGPT launched in November of 2022. Now, some would say, well, obviously, and all of that might be justified, but those are large numbers. Those are really large numbers that have carried a boatload of the weight of this move in the market since then.
Yeah, and that's a moment in time, Scott. I mean, just to give some perspective, NVIDIA is about 8% of the S&P 500 market cap weight, but it is also 7% of the earnings. So it's not necessarily distorting equity valuations. And in terms of what companies are excited about, if companies are saying that AI is something where they're actually allocating capital, and many are, of course, are seeing productive gains, I think it's justified that would be what you'd expect to be the first wave of investment and spending, is around directly into the ecosystem. But of course, over time, we'd expect that spending then to deliver productivity gains and other benefits. So that means if AI, and I'm comfortable with the idea it's a super cycle, we should see a broadening of the benefits and then also the broadening of opportunities over time. So it's probably a moment in time makes sense, but it should be broadening.
Tom starts from a simple idea. We're living through one of those rare moments where a new technology meaningfully changes the trajectory of productivity and profits. He calls it a supercycle, an extended period of exponential opportunity around AI. Now that doesn't mean every stock with AI in the press release deserves a sky-high valuation. It means the pie is getting bigger, but not every diner at the table deserves the same portion. That nuance matters. To ground that, he brings up valuations. The knee-jerk take in a hot market is, this looks like 1999. Tom pushes back with actual context. He compares today's AI bellwether NVIDIA to the late 90s networking titan Cisco at a similar point in that cycle. NVIDIA at roughly 26 times forward earnings versus Cisco at 60 times back then, which later peaked over 200 times. The point isn't that 26 is cheap in a vacuum. The point is that relative to past bubbles at true mania stages, today's market leader isn't priced like the sun will never set. In fact, Tom makes the bolder claim. NVIDIA is cheaper than a couple of beloved consumer staples that trade closer to 50 times forward earnings. You might say, different sectors deserve different multiples, and that's fair, but the comparison is meant to reset the scale in your head. If you're going to call something a bubble, show me the bubble math. Tom is basically saying, we're not there, at least not for the highest quality names whose earnings power is visible, durable, and compounding. Next, he tackles a huge misunderstanding that's driving a lot of FOMO and frankly a lot of bad trades: scarcity. There are two kinds. There's public market scarcity, where a stock rips because it's the only way for public investors to get exposure to a hot theme while dozens of private competitors still lurk off exchange. And there's ecosystem scarcity, where the company is truly N=1, uniquely positioned with a defensible moat, supply chain control, and software-hardware integration that make it hard to replicate. One kind of scarcity is technical and temporary, the other is strategic and lasting. If you confuse them, you'll pay up for names that are simply the only ticker to buy today, rather than the indispensable node in the value chain. Tom's advice between the lines: pay up for true ecosystem scarcity, not for a ticker's novelty. He's also addressing a stat that's on a lot of minds. Since late 2022, AI-related stocks have carried a massive share of the S&P 500's total return, earnings growth, and capex growth. You've seen the numbers: roughly 3/4 of the return, 4/5 of the earnings growth, 9/10 of the capital spending growth. Those are huge, and they make people uneasy because concentrated leadership can feel fragile. Tom's counter is that it's a snapshot in time, the first wave of a new investment cycle. Early on, the spending and the returns are naturally concentrated in the enabling layer: chips, accelerators, hyperscale cloud, foundational software. That's where the dollars go first, and that's where the obvious productivity gains show up first. If it's a real supercycle, you should expect a second wave where the benefits diffuse outward, into industries that adopt and deploy, not just those that supply. He gives another useful anchor. NVIDIA is around 8% of the SP's market cap and roughly 7% of its earnings. That means it's not just a giant price tag sitting on a tiny profit stream. The company's contribution to earnings is in the same zip code as its weight. The larger message is that leadership isn't purely multiple expansion. It's tied to actual earnings power. Again, not a free pass to buy anything that rhymes with AI, but a reminder that quality leadership with real profits is different from story stocks with little cash flow. Now here's how I interpret the roadmap implied by Tom's comments. Phase 1 is the infrastructure build-out: GPUs, networking, memory bandwidth, data center power, and the cloud stacks that orchestrate it. That's what we've watched play out. Massive capex from hyperscalers, tight supply in the most advanced components, and extraordinary pricing power for true bottlenecks. Phase 2 is productivity diffusion. Enterprises deploy co-pilots, agents, and AI-enhanced workflows across sales, customer support, software development, design, and back office. This is where we see margin expansion in seemingly non-AI businesses and a broadening of market leadership beyond the magnificent few. Phase 3 is application liftoff. Category winners in vertical AI and edge AI that aren't obvious today become tomorrow's household names. If the supercycle frame is right, we're somewhere between late Phase 1 and early Phase 2. Where do I agree with Tom? Strongly on 3 points. First, the late 90s analogy is lazy unless you pair it with math. When you actually stack forward multiples against earnings contribution and cash generation, the leaders today aren't priced like Cisco at peak mania. Second, scarcity discipline is essential. If the stock is up because it's the only listed proxy, be careful. If it's up because it's the irreplaceable node with structural advantages, that's different. Third, concentration of returns early in a cycle doesn't automatically mean fragility. It can be the natural signature of an enabling technology wave. Where do I think investors need to stay skeptical? Also 3 things. 1. 26 times forward is not inexpensive if growth stumbles. Any hiccup in the supply chain pricing or the adoption curve will magnify downside. 2. Diffusion takes time. The market loves to price in phase 2 overnight, but enterprise adoption is messy. Budgets cycle annually, integration is hard, and ROI proofs can lag. That can create air pockets in second-tier names that ran ahead of fundamentals. 3. The N=1 framing can tempt us to overconcentrate. Even if a company looks singular today, technology stacks evolve. Keep humility in the position sizing. So how do we translate this into a practical framework after a big run? Start by ranking exposure along the stack. At the base are the compute and networking bottlenecks, true scarcity, durable demand visibility, and pricing power. In the middle are cloud platforms and software layers where monetization is increasingly usage-based. Here you want evidence of attach rates, net revenue retention, and AI-specific SKU lift, not just demos. Up top are applications and adopters. This is where you screen for measurable productivity gains. Faster code releases, lower customer support, handle times, higher sales conversion per rep, and tangible OPEX savings. The trade is to be overweight quality in the base layer, selectively add proven monetizers in the middle, and be surgical in applications until the KPIs prove out. Risk management matters more than ever. If you've enjoyed outsized gains in the leaders, consider trimming to target weights rather than abandoning positions. Use earnings dates as catalysts. Leaders with strong visibility often guide conservatively. Challengers tend to overpromise. Watch CAPEX commentary from the hyperscalers. It's the real-time pulse of Phase 1 health and an early signal for when Phase 2 accelerates. And keep an eye on power and supply constraints. Those can swing delivery timelines and sentiment quickly. The takeaway from Tom Lee's interview isn't buy everything AI or run from a bubble. It's a blueprint for discernment in a real supercycle. Respect the earnings, respect the bottlenecks, separate public market scarcity from ecosystem scarcity, and expect the benefits to broaden as productivity shows up outside the enablers. That's how I'm thinking about the next leg. Own the indispensable, verify the monetizers, and give the adopters a higher bar. If the cycle continues to play out the way Tom describes, leadership won't vanish. It will share the stage with new winners as AI moves from build-out to payoff. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into the 2 AI stocks to buy for the long haul. First up is ASML Holding NV, ticker ASML, the backbone of the global semiconductor industry. If you've never heard of ASML, you're not alone. This Dutch company keeps a low profile, but its influence is absolutely massive. In fact, you could argue that the entire modern digital world, your smartphone, your laptop, the servers powering the internet, and especially the AI revolution, would grind to a halt without ASML's technology. It's the silent force behind every major leap in computing power over the last decade. ASML provides the advanced lithography machines that make cutting-edge AI chips possible. These machines are the heart of the chip-making process, enabling manufacturers to etch impossibly tiny circuits onto silicon wafers. Without ASML's technology, the chips that power everything from data centers to self-driving cars simply couldn't exist. It's not a flashy name, but it's the ultimate picks and shovels play for the AI gold rush. While everyone else is chasing the next big AI chip designer or software breakthrough, ASML quietly profits from every single chip produced, no matter who designs it or where it's made. If you want to invest in the infrastructure behind the AI boom, ASML is the company to watch. Every advanced chip maker, TSMC, Samsung, Intel, relies on ASML's equipment for the most critical step, lithography. This is the process that defines how small and powerful a chip can be. Without ASML, even the most innovative chip designs would remain just that, designs never brought to life in silicon. When it comes to extreme ultraviolet EUV lithography, there's literally no one else. ASML has a total monopoly. EUV is the only technology that allows chip makers to print features just a few nanometers wide, which is essential for the latest and greatest AI chips. No other company on Earth can build these machines at scale, and it's not for lack of trying. EUV technology is mind-bogglingly complex. High-energy lasers vaporize tin droplets, creating plasma that emits EUV light, which is then bounced off ultra-precise mirrors to etch circuits just a few nanometers wide. To put it in perspective, the mirrors used in these machines are so flat that if they were the size of the United States, the tallest bump would be less than a millimeter high. The engineering required is on a level that borders on science fiction. This precision lets companies cram billions of transistors onto a single chip, making them faster and more powerful. The more transistors you can fit, the more calculations a chip can perform per second, which is the key to unlocking new levels of AI performance. It's the reason why every leap in AI capability is tied to advances in chip manufacturing, and why ASML sits at the center of it all. Developing EUV took ASML decades and tens of billions in R&D. The result? A technological moat so deep competitors like Canon and Nikon can't even come close. ASML's lead isn't just about patents or know-how, it's about a global supply chain, thousands of specialized engineers and partnerships with companies like Zeiss for optics and Trump for lasers. Even if a competitor started today, it would take them years, if not decades, to catch up. A single EUV machine costs over $200 million, and there's a waiting list. When chipmakers build new multi-billion-dollar fabs, a huge chunk goes straight to ASML. These machines are so complex that it takes a team of engineers weeks just to install one, and they're shipped in pieces on multiple jumbo jets. The demand is so high that ASML's order backlog stretches years into the future. As demand for AI chips explodes, so does demand for ASML's machines. They benefit no matter which chip designer wins. Whether it's NVIDIA, AMD, or a startup you've never heard of, if they want to make the fastest chips, they need ASML's technology. This means ASML is positioned to profit from every wave of innovation in AI, cloud computing, and beyond. ASML enjoys fantastic gross margins, often over 50%, and a predictable growing revenue stream, thanks to a massive backlog and recurring service contracts. Every machine they sell comes with years of maintenance and upgrades, creating a steady flow of high-margin revenue. Investors love this kind of business model because it's both resilient and scalable. Their business model is built on an unassailable technological foundation. The barriers to entry are so high that even the world's largest tech companies can't break in. ASML's dominance is protected not just by its technology, but by its relationships with the entire semiconductor ecosystem. ASML's success is also a story of collaboration. Their EUV machines rely on ultra-precise lenses from Zeiss, high-powered lasers from Trump, and a global network of suppliers. This web of partnerships is nearly impossible to replicate, giving ASML another layer of protection against competition. Geopolitics only highlight their importance. Governments worldwide see semiconductor independence as national security, and ASML's tools are at the heart of it. The US, China, and Europe are all racing to secure access to ASML's technology, and export controls have made these machines even more valuable. Even with export restrictions, their tech is so critical that global demand remains strong. Countries and companies are willing to wait years and pay a premium just to get their hands on ASML's machines. This demand isn't going away anytime soon. Risks? The biggest is a downturn in the semiconductor industry, which could slow orders. If global demand for electronics drops, chipmakers might delay new fabs or cut back on equipment spending. But history shows that these downturns are usually temporary, and the long-term trend is up. But the long-term trend, driven by AI, cloud, and IoT, is clear. More chips, more ASML. As our world becomes more connected and intelligent, the need for advanced chips will only grow. Every new application, from autonomous vehicles to smart cities, means more business for ASML. Another risk is the complexity of their tech. If they hit a major technical hurdle, it could be a problem. These machines are so advanced that even a small glitch can cause delays or cost millions to fix. But ASML has a long history of overcoming technical challenges, and their R&D team is among the best in the world. But their track record and R&D muscle make this unlikely. ASML invests billions every year to stay ahead, and their culture of innovation is legendary in the industry. They've solved problems that once seemed impossible, and there's every reason to believe they'll keep doing so. Valuation is high, but so is their monopoly power and growth potential. You're buying a dominant position for the next decade, not just the next quarter. In a world where most tech companies face fierce competition, ASML stands almost alone at the top of its field. In summary, ASML has a monopoly on the most critical tech for advanced semiconductors, a moat competitors can't cross, and direct exposure to the AI industry's growth. Their machines are the gatekeepers to the future of computing, and their influence will only grow as technology advances. Their financials are strong, with high margins and a massive backlog. This isn't just a story of technology, it's a story of consistent, reliable growth, backed by some of the best fundamentals in the industry. It's a quiet giant, but one of the most powerful and strategic companies on the planet. While others chase headlines, ASML quietly shapes the future from behind the scenes, making it a cornerstone of the global tech ecosystem. ASML is also investing in the next generation of talent, partnering with universities and training thousands of engineers. This ensures their leadership will continue for decades and that the world's brightest minds are working on the next breakthrough in chipmaking. The world simply cannot build the future of AI without ASML. Every major advance in artificial intelligence, from language models to robotics, depends on the chips that only ASML's machines can help create. That's why it's the first stock on our list today. If you want to own a piece of the future, ASML is where you start. Next up is NVIDIA, ticker symbol NVDA, the undisputed leader in the world of AI hardware and software. If you've heard about the AI boom, you've almost certainly heard NVIDIA's name. The company has become synonymous with artificial intelligence, powering everything from the world's most advanced data centers to the latest breakthroughs in generative AI. In fact, it's hard to overstate just how central NVIDIA is to the current AI revolution. NVIDIA's story began in the world of gaming. Founded in 1993, the company originally set out to build the best graphics cards for video games. Their GPUs, graphics processing units, quickly became the gold standard for gamers seeking the most immersive, visually stunning experiences. But what started as a quest to make games look better soon revealed a much bigger opportunity. It turned out that the same chips that rendered lifelike graphics were also perfectly suited for the complex, parallel computations required by artificial intelligence and machine learning. CEO Jensen Huang, a visionary leader and one of the original founders, recognized this potential before almost anyone else. Under his guidance, NVIDIA made a bold pivot, transforming from a gaming hardware company into the engine that would drive the AI revolution. Huang's willingness to bet big on AI, years before it became mainstream, is a huge reason why NVIDIA is so far ahead of the competition today. He's not just a CEO, he's become an icon in the tech world, known for his signature leather jacket and his ability to spot the next big thing before anyone else. Fast forward to today, and NVIDIA's data center business has exploded. It's now the company's largest and fastest growing segment, dwarfing its original gaming business. These data centers are the beating heart of the AI world, running the massive computations needed to train and deploy advanced models. Every time you interact with an AI chatbot, use a smart assistant, or see a mind-blowing AI-generated image, there's a good chance NVIDIA's hardware is working behind the scenes. The secret sauce? NVIDIA's H100 and Blackwell series GPUs. These chips are the gold standard for AI training and inference, capable of processing mind-boggling amounts of data at lightning speed. Massive AI models like ChatGPT, Google Gemini, and countless others are trained on clusters of these GPUs, sometimes numbering in the tens of thousands. The H100 in particular has become the must-have chip for any company serious about AI, and the new Blackwell series promises even more power and efficiency. The result? NVIDIA holds an estimated 95% market share in chips used for training large language models. That's not just leadership, that's total domination. No other company comes close. This dominance isn't just about having the fastest chips, it's about having the complete package: hardware, software, and a thriving ecosystem that keeps customers coming back. But here's where NVIDIA really pulls away from the pack: software. The company's 𝗗𝗜𝗏 platform is a game changer. 𝗗𝗜𝗏 allows developers to tap into the full power of NVIDIA GPUs for all kinds of computing tasks. Not just graphics, but scientific research, deep learning, and more. It's a powerful toolkit that's become the backbone of modern AI development, enabling breakthroughs in everything from medical research to autonomous vehicles. NVIDIA has invested billions of dollars and more than a decade of engineering into 𝗗𝗜𝗏. The result is a sticky ecosystem. Millions of developers worldwide have built their skills and their software around NVIDIA's tools. For companies, this means high switching costs. Once you're in the NVIDIA ecosystem, moving to a competitor isn't just about swapping out hardware. It means rewriting code, retraining staff, and potentially losing years of progress. That's a massive barrier to entry for would-be rivals. Even if a competitor comes along with a faster or cheaper GPU, the cost and complexity of switching are enormous. Companies would need to overhaul their entire software stack, retrain their engineers, and risk disrupting mission-critical operations. For most, it's simply not worth it. This is what's known as a moat, a durable competitive advantage that protects NVIDIA from rivals and keeps customers locked in. This unbeatable combination of world-class hardware and a software ecosystem gives NVIDIA incredible pricing power. The company's gross margins are often in the high 70% range, numbers you'd expect from a software company, not a hardware manufacturer. This means NVIDIA can reinvest heavily in research and development, staying ahead of the curve and continuing to set the pace for the entire industry. And NVIDIA's reach goes far beyond just data centers. Their technology powers self-driving cars, enabling vehicles to see and make split-second decisions. In Hollywood, NVIDIA GPUs are behind some of the most stunning visual effects you see on the big screen. Engineers use NVIDIA-powered simulations to design everything from airplanes to skyscrapers. And of course, gamers still rely on NVIDIA for the ultimate PC experience. The company's influence touches nearly every corner of the tech world. Of course, no company is without risks. NVIDIA's stock price has soared, and its valuation is sky-high by almost any measure. At some point, growth will inevitably slow, and any sign of weaker demand or rising competition could send the stock tumbling. Investors need to be aware that the higher the expectations, the greater the risk of disappointment, and make no mistake, competition is coming. AMD and Intel are both racing to catch up, pouring billions into their own AI chip designs. Meanwhile, cloud giants like Amazon and Google are developing custom chips to reduce their reliance on NVIDIA. These companies have deep pockets and strong incentives to break NVIDIA's stranglehold on the market. But so far none have managed to match the combination of performance, software, and ecosystem that NVIDIA offers. There are also significant geopolitical risks. NVIDIA's supply chain and a large portion of its revenue are tied to Asia, especially Taiwan and China. Ongoing tensions between the US and China, as well as potential export restrictions, could impact NVIDIA's ability to sell its most advanced chips overseas. Any disruption in the global supply chain could have ripple effects throughout the tech industry. Still, the long-term bull case for NVIDIA remains incredibly strong. Artificial intelligence is not a passing fad. It's a multi-decade transformation that will reshape every industry, from healthcare and finance to manufacturing and entertainment. As the demand for AI processing power continues to skyrocket, NVIDIA is uniquely positioned to benefit at every stage of this technological revolution. In many ways, NVIDIA isn't just participating in the AI revolution, it's enabling it. The company is selling the picks and shovels for the digital gold rush, providing the essential hardware and software that make modern AI possible. As more industries adopt AI, NVIDIA's addressable market will only continue to grow. With best-in-class hardware, a nearly insurmountable software moat, and exposure to the biggest tech trend of our lifetime, NVIDIA is a core holding for long-term investors. It's a company that has repeatedly reinvented itself, staying ahead of the curve and delivering value to shareholders year after year. For anyone looking to invest in the future of technology, NVIDIA is a name that belongs at the top of the list. That's why NVIDIA is the second stock on our list, a true powerhouse at the heart of the AI revolution, and a company that's likely to shape the future of technology for years to come. So there you have it, ASML and NVIDIA, two powerhouses at the very core of the AI revolution, each playing a unique and irreplaceable role in shaping the future of technology. These companies aren't just riding the AI wave, they're building the very foundation that makes it all possible. ASML is the silent monopoly behind every advanced chip, providing the world's most sophisticated lithography machines that enable the creation of cutting-edge semiconductors. Without ASML, the chips that power everything from smartphones to supercomputers simply wouldn't exist. On the other hand, NVIDIA stands as the king of AI processing, designing the GPUs that drive breakthroughs in machine learning, data centers, and autonomous systems. By investing in both, you're not just picking two companies, you're betting on the infrastructure that will power the entire AI-driven economy for years, if not decades, to come. This strategy gives you exposure to both the essential hardware and the innovative processing power that are fueling the next generation of technological advancements. Of course, it's important to remember that every investment carries risk. The tech landscape is always evolving, and even industry leaders face challenges from competition, regulation, and global events. That's why you should always do your own research, stay informed, and consider your own financial goals before making any investment decisions. So, which company are you more bullish on for the next decade? Do you see ASML's technological edge as the ultimate moat, or do you believe NVIDIA's relentless innovation will keep it ahead of the pack? Or maybe there's another AI infrastructure stock you think is flying under the radar, one that deserves more attention from investors looking for the next big opportunity in this space. Let me know your thoughts in the comments below. I love hearing your perspectives and learning about new companies or trends I might have missed. And if you found this video helpful, don't forget to like, share, and subscribe for more in-depth investing insights and updates on the latest trends in technology and finance. Thanks for watching, and I'll see you in the next one. Until then, happy investing.